Hey guys, Shawnee Mini School. Just doing a follow-up video from today. We were looking at the NQs in the last video, saying, I think we looked at the Russell too, saying this level, this whole level right here is 60-minute support. Okay, so there's upper target still, but today, basically I want to kind of just go over a couple charts. So we gap up, right? It runs up. On 10-minute, we have blue bars at this high. Okay, same thing at this low. You'll see on this low it went down a little bit more. We're not interested in that short. Okay, same thing here. Now this is an example of most likely you wouldn't be long from just, right here. If you were trading pre-market and you got long somewhere, that's another story, but based on this chart alone, not really an entry right here. Okay, so let's say you're flat coming up into this high. Okay, at this point, we wouldn't want to be going long, just like down here, we're not interested in going short. Okay, until we would get a pullback. Okay, and you can see off of this high, market did come down. Okay, very good level to stop going long. So if there's a gap or there isn't a gap, it doesn't matter. Okay, so on a small time frame, if you were scalping this move, at this point you would want to stop scalping long. The odds are it's a top relative to the time frame you're looking at. So this is a 10-minute chart. So we would get a pullback, okay, that is big enough that if you try to go long, okay, you're probably going to get stopped. So we'll break this down into a 5-minute, and you can see that we also had blue bars here. So once a blue bar prints, okay, you start trailing the stop. Okay, basically you would stop thinking long here or exit your long position. Okay, you'll notice how this chart looks a little bit different. It has blue bars down here as well. That means that this move down is most likely over. Look for it to correct or resume the bigger direction. So a way to play this is when we look at the scalper, okay, this is a 6 range, and I'll break this down into a 4 range too so you can see the difference. Which one is absolutely right depends on the condition of the market. The whole point of breaking it down into a range is to get a different view of the market, right? Scalping on a 1-minute chart is very, very hard because the candles don't really tell you anything. You really want to break it down into a different view. Okay, so this is the 6 range. This was basically overnight. Okay, it pulls down. Okay, indicator along right here. This would be an aggressive counter trend trade. Okay, this would be an aggressive counter trend trade. So if you did take it, you're really just looking for a reason to get out once you're in. This is not a trade where you just leave the stop unknown, hoping something big happens to the downside just because there was a gap up, and then you let the trade get way out of hand. We're up at a new high and you're just hoping it comes back down. So I really, market gaps up. Your first initial thought might be, I'm going to short it because it's going to go down. It's too basic of a thought though. Yes, it might go down to fill the gap, but chances of it doing right when you enter are very low. Market very rarely goes really strong up to really strong down. Even though a lot of people might want it to do that, it's not really the reality of really what it does. Okay, and it's very important to, trade really what it's doing. And the condition of the market can really help you in multiple ways. If it's going to be a contraction on a bigger time frame, which means sideways, you probably don't want to keep going for a home run trade or a big trade. Those are the days where you're better off just scalping it for 2 points, right? If your conditioned thought is it's going to make a big move and you try that 4 or 5 times and you do have the 2 points in it, but you keep getting stopped even, you would have been better off just taking the 2 points and closing it out profitable money-wise, but also confidence-wise for the next day. So this is what the 6 range looks like. There was a couple of longs over here. Okay, and this indicator does a good job of showing the direction. So obviously if the direction is down, way too soon to go long. Even over here it's too soon. This would be an aggressive long right here. Okay, this over here is much more conservative. So if I had to only trade one trade for the day, right, my goal is 2 points for the day. I'm going to wait for the best setup. This is it right here. This is more of a continuation setup. Okay, and there's also a continuation setup here. Okay, then we have rules, when to stop trading as well. But same thing over here. It's down, it's red. We're not interested in going long. Same thing here, right? The visual, we need the visual to, and when you first start using this, you still might have a thought to, oh, it's ran up, I'm going to short it. It's really just skipping those thoughts. If you can skip most of your bad trades, it makes the winners that much more because you're keeping them. Okay, so this is a 6 range. I'll break it down to a 4 range. There's not one over the other, but you can see it looks a little bit different. There's much more waves in it, okay, which means potentially you can get in a little bit quicker with smaller stops, okay. But on any chart, there's going to be minor waves that all make up a major wave, okay. So from this high, you can see it a little bit better, okay, on this counter trend short. Could you short it right there? Yeah, but the 5 minute, the 10 minute, they're both green at that point. So you don't really want to, go indicator counter trend. You would want to do a rejection of the pattern counter trend. You can see that worked out, but you don't want, this is just a scalp counter trend. You're looking for a reason to get out right when you enter the trade, not a home run. So we'll probably do a webinar tomorrow, and we'll go over minor, okay, and major waves. It's very important to understand those. No matter what indicators you're using, what style, it doesn't even really matter. It can help you not trade counter trend on a minor wave. That's really where the highest percentage of losing trades occurs, is counter trend on minor waves. They look easy, but they're very obvious, and the potential, even if they're winners, is still very low. So those are really things to avoid, and we'll go over that tomorrow. See you guys in the next video.